What's up, Gould Miners? Today, we welcome back to the Gould Mine, Elijah Brown, the CEO of Goldhawk Capital, a fund of funds that invests primarily in multifamily deals here around the United States. Elijah is our very first Gould Mine repeat guest, and it's very fitting that he is because he is an encyclopedia. He is a knowledge base of information when it comes to real estate investing strategies. In this episode, Elijah and I start off by talking about some of the metrics, some of the tricks of the trade when it comes to analyzing properties in 2024. You might be surprised to know that Elijah's not really looking right now at IRR and equity multiple as much as some of these other metrics that he mentions in the show. Later on in the episode, Elijah highlights some of the unique value add strategies that him and his partners are using on Class A and Class B properties. And then finally, Elijah and I wrap up the episode by discussing the current distress in the commercial real estate sector and why, despite having relatively high levels of distress, we haven't had total carnage yet, and what to expect in terms of distressed assets for the remainder of 2024. Some incredibly high level of conversation here, everyone. So without further ado, let's welcome back to the show, Elijah Brown. Elijah, welcome back to the Gould Mine.
Danny, thanks so much for having me back. I actually had a dream last night, like not joking at all, that I was doing the intro sequence for your show. And I was like, Gould Miners, we have our next guest here. And I was like really excited because every time I listen to your podcast, I'm like triggered by it a little bit because it's so catchy. It's so good. So yeah, that's what I was thinking about last night when I was unconscious.
Yeah, I don't know. Appreciate that, man. Glad to know that I'm in good thoughts there. So, you know, by the way, I don't know if you know this, but you are officially our first repeat guest.
Yeah. Awesome.
Yeah.
I feel special. Thank you.
Yeah, man. Well, I mean, you're just a treasure trove of knowledge. And so I was like, dude, I got to get Elijah back on the show, do a part 2.
You're too nice.
And who knows? You know, I'm sure that you'll be on many times. So this is the second of many. Catch us up on what's been going on with yourself and with Goldhawk since the last time that you were on.
Sure, we've been plugging away, doing deals, mostly through our fund of funds model, which we'll go into a little bit later. But we've been making relationships with new sponsors, operators, and essentially just plugging away at the same stuff we've been doing just over and over again. Some of you listeners who might follow Alex Hormozy, you got to do the hard work over and over again for like 5 years straight before you really see those results. And so we're now in that point where we've kind of been through the valley of despair, and now we're just like in scale mode and just repetition of like what's working and doubling down on what's working and trying to grow the business.
Dude, Hormozy is G. Hormozy's awesome.
Love him. Yeah.
Yeah. There was a period last year where like for a month straight, I just like drank his like content like a fire hose. I was like
so
for
good.
4 hours, I was like Hormozy University, basically just like taking notes. So yeah, no, he has a lot of great stuff. So speaking of Hormozy, right? Because I haven't really talked to I've talked to a lot of people in real estate sales who follow Hormozy, but not a lot of people who follow him in the fund space. I'm curious, like, what's one thing that stuck out to you? And I know I'm kind of putting you on the spot, but like, what's one thing that's like really stuck out to you that you have been able to apply to your real estate fund? Like, what's one teaching, one learning that you've been able to apply from his stuff?
Yeah. So the important thing is that like, funds and real estate, it's literally just like any other business. So when Hormozy's talking about all these pieces of advice that he has, it's not just for like tech startups or selling a product or doing a service. It really applies to like everyone. And so like the whole fund thing and real estate stuff, it's just like any other business. It's just like a tech startup. It's just like a mom and pop ice cream shop on the corner. It's the same principles apply no matter like what space you're in. And so that's like the real important thing. The biggest takeaway I've had from really his advice is that, you can't sell a shit product, and excuse my language, but start with the value of what you're actually providing. So like if you're going and selling some type of like tech software, make sure it's like super valuable and super good, because there's no point in like spending marketing dollars and going like deep and trying to like spend all these resources and time and effort and money when you have a bad product to begin with. The same thing is in real estate and funds. If the deals that you are pitching to your investors are like bad deals or not attractive to those investors, then it really doesn't matter. Like you shouldn't spend any money on marketing. You shouldn't hire people. You shouldn't like try to scale that up until you really have like a proof of concept and a market fit. And so that's important. We spend a lot of time now focusing on the actual product that we're offering to the market. And for us, that's investment opportunities.
Yeah, that makes, by the way, you can say shit on the show. All right, so you're fine. Yeah.
All right.
You could absolutely say.
I got a little scared there. I was like, oh no, you're gonna have to like put like the beep thing and like blur out my face.
Definitely not, man. Definitely not. No, I'm not even gonna go down that road. But anyways, yeah, the idea of because a lot of this stuff, right, is when you listen to it, there are certain things where you're like, he's talking about like products or he's talking about services, but really, in the fund space, you can think of like your fund management, your side, all that's as a service, but also there is a product too. It's very interesting that you think of it that way, where like the deal is the product.
It is, absolutely.
Yeah. That's an interesting take. Maybe we might come back to Hormozy in a little bit, but I want to continue down, the original path. So obviously some good stuff has happened. You've gotten more momentum. You've picked up a couple of different partnerships.
Yeah.
Since the last time that we spoke, what's one pivotal moment? What one thing that has happened in the last 6 months that stands out to you?
Definitely a shift in investor mindset. So a lot of sponsors and operators got into a lot of trouble in the past year because they took on deals with, short-term floating rate bridge debt. And that's really dangerous because in an environment like we have now, where interest rates are a lot higher than they were a few years ago, it's almost impossible for a lot of these sponsors to refinance when their loans mature. The bank requires that these properties kick off enough income to be able to support paying a mortgage. And when that mortgage payment is so much higher due to interest rates being high, the bank's not going to lend as much money because they need to make sure you can actually make the payment. And so you've got sponsors right now that are being faced with $10, $20, $50 million cash in amounts for these refinances. And that's just a massive amount, especially when a lot of investors are still on the sidelines and not ready to jump in. And so there's been a lot of shifting of mindset among investors, like limited partners and also the institutional guys as well. There's a lot more focus right now on the debt terms. There's a lot more focus right now on cash flow, yield, and a lot less of a focus on, IRR, equity multiples, exits, stuff like that. Like, it's gone back to a situation of like, let's focus on the fundamentals and the cash flow and the risk of the deal rather than, what could we possibly sell it for in the future?
Yeah, that's interesting. And I'm wondering, based on what you've seen, has there been, have you seen a lot of LPs, a lot of investors who got burned in the last couple of years?
Oh, yeah.
Are you seeing a kind of like a clamming up effect where there's less investor capital available, like people like not really willing to put money into deals right now?
It's really interesting. So a lot of investors have gotten burned. A lot of people that I know. I mean, I have sponsor friends who have given keys back to the bank, and I have a lot of investor friends that have lost all their money. It's scary. But what I'm not seeing is that those investors are not writing checks. Those investors are still writing checks. They're still eager to write checks. I want to compare this with gambling addicts, like casinos. It's not the same. But it's like, even if someone loses money, they think that they learned something and they go and they do it again. which is actually not bad. It's like you learned your lesson by losing money on a deal, and now you're going to go and invest more conservatively. And that's what's happening right now. A lot of investors either lost money or their distributions were paused or they got really scared for 6 to 12 months. And now they're still writing their checks. They're still writing checks, but they're a lot more conservative in their analysis.
So how does one underwrite conservatively? Because here's the thing, right? Like it's actually kind of like, it's so cliche, bro. You know, almost every fund manager, almost every syndicator that I talk to, they all say the same thing. Well, we underwrite conservatively. And it's like, all right, but what does that actually mean, right? Like, how are we underwriting these deals conservatively? I hear what you're saying. So one of the things that we do is we can look at it from different lenses. Cash flows, yield versus IRR and equity multiple, which is kind of like the gold standard or what a lot of people have been looking at. So, but that's just like optics or like looking at it through a different lens. How are you, I guess, underwriting conservatively, or what are you doing to kind of like check the conservative box?
The more deals that I look at, the more deals that I do, the simpler it's becoming. Before, 5 years ago, I was like, I got to do an entire underwriting model and calculate all these metrics. And then all these metrics need to be within a certain range. And it was like really complicated. Now it's like, it boils down to like 3 or 4 like specific things that I look for that tells me if a deal is going to be safe and conservative. We'll just start with one: debt service coverage ratio. Essentially, what that is, it's the net operating income, so your cash revenues minus your cash expenses, divided by your loan payment every month. And that should tell you like how many times your loan payment are you making. And it's really simple, right? It's like, are you actually bringing in enough cash flow every month to pay the mortgage? And is there a comfortable margin there? We typically look for like a 1.25 going in on that. So we want to see 1.25, the debt service, being generated in cash flow. It's a really, really simple metric. And it pretty much just says, cool, this deal is not really at a high risk of loan default from not being able to make the payments. It's like a really simple metric. And that's like one of the most important things that we look for. A lot of people were going in and doing deals back in 2020, 2021 on bridge loans where their debt service coverage ratio was like 0.5 or 0.8 or even 1.0 just for that first year while they were executing the business plan. Well, you know what that does? That requires you to put a whole bunch of extra cash in a bank account to be able to make those loan payments. And it also increases the execution risk. Because what happens if something happens and that sponsor can't finish the renovations or execute on the business plan? A whole number of different reasons. Well, you're screwed because you can't make the mortgage payment now. So the one most important thing we really look for is on day one, can you comfortably make that mortgage payment? Yeah.
Okay.
Should I go into more?
Absolutely.
Okay.
What else? So DSCR is one of them.
Yeah.
What else? What else are we looking at as well?
Yeah. So I want to introduce the concept of positive leverage. And this is a little more confusing, but it's pretty much along the same lines. It pretty much says the cap rate that you're buying the property at. So like historical income divided by the purchase price. That's the formula of it. That percentage number should be higher than the interest rate that you're paying on your mortgage. And it's just a really simple rule. We like to look for like 150 to 200 basis points of spread there. And all that's really saying is that, great, the property's going to cash flow enough to pay the mortgage. It's the same thing. And we really use that for a determination of how much leverage we should put on this property. If there is a really big spread between income generated and the mortgage and the mortgage payment, the interest rate, then we're comfortable increasing the leverage from 70 to 80% even. But if you're buying that property and there's not positive leverage, or it's a very low amount, like you're paying a 6 cap and the interest rate's 5.5%, then I would look at that and say, you probably shouldn't borrow so much money because you're going to get yourself in trouble. So that's one that we look for as well. And then there's a couple more. The next one is yield on cost, and this is like stabilized. So what this one says is once the business plan has been executed, renovations have been done, rents have been increased, what is your operating income, stabilized operating income, divided by as a percentage of your total cost of getting into the deal? That includes your purchase price, closing costs, renovation budget, working capital. Like that's like you're all in. So like how much cash flow is this property kicking off as a percentage of your all-in costs? It's like your return on cost every year. So that's an important one. We use that to know, like, is the deal going to yield enough cash flow to make distributions to our investors? And like that, it's just really that simple. It's just cash flow metrics.
Yep. The positive leverage, it's so funny because you like literally 2 podcasts now back to back have talked about the positive leverage, and it seems so simple, right? Because it's just like, hey, is your cap rate, like is your entrance cap rate higher or lower than your mortgage interest rate?
Right.
It's just like
that's it. Yeah. Simple.
It is simple, but yet I feel like, especially in parts like, for example, I'm in California, and I don't know if any multifamilies here have been sold with, a positive leverage in years. I mean, it's especially after the interest rates went up, it's crazy. And I'd always thought about that, even as I sold apartments here, sold multifamily buildings here, and I'm just doing the math in the back of my head. I'm like, how is this a good deal? Like, I don't get it.
To some people, and in their defense, like, it is great for some people, like larger institutions that are willing to accept the possibility of no or negative cash flow for the chance that their equity doubles or that their equity goes way up with the trend of inflation. And so it's like, it makes sense for some people. For me, it doesn't make sense. For a lot of, retail and mom and pop investors, like that doesn't make sense at all, because it's like, it's scary, the prospect of having negative cash flow and not hitting projections and not being able to pay the mortgage. But for some buyers, that really makes sense.
So just to revisit, because I know that not all of our listeners today listened to the first time that you were on, and it's important to know that, Elijah runs a very distinct type of fund. He is not directly, not like the direct sponsor or the asset manager, right, of these properties. So you run a fund of fund model, right, Elijah. So can you explain to our listeners, the audience, what that means and how, what some of the advantages are of investing into a fund of funds model?
Sure. So I was an active operator for about 7 years. I still have a few properties left. And when I was doing that business, I was in charge of like everything: finding the property, finding the bank, finding the investors, finding the property manager, finding the contractors, doing all the work, holding all the pieces together. And it's brutal. Sure. I sold a bunch of those properties and made the decision that I wanted to focus on what I was good at and just provide capital allocation, like raising money and due diligence services to existing companies that were far more advanced than me, that were finding much better deals than me, that had the team in place and the vertical integration to get deals done way better than I ever could. And so my business model became just raising money essentially for really good opportunities. And there's 2 ways that you can really do that legally. The first way is by joining the actual deal's management group, their operating agreement, as a co-GP or a co-manager. You're actually like listed as a manager on the operating agreement. And your investors that you bring into the deal come directly into the deal. And that's great. And you make your money by charging fees to the investors at that deal level. Now, most operator groups, unless you're bringing a significant portion of the capital, they're not just going to let you join as a manager. Like you got a $2 billion or a $5 billion company, and you're bringing them, $500,000 or $1 million. Like they don't care. They're not going to give you any type of like special treatment for that. They're not going to invite you into their management for that. And so there's another strategy, another structure that you can use if you want to bring in smaller check sizes. And that's what I've been using. Essentially how this works is you go out and you set up a completely separate LLC, completely separate entity, and you raise money within that entity for someone else's deal. Once you've raised all that money, let's say you get $1 million worth of investors in your separate entity, you then write one check from that entity to the sponsor for their deal. And usually because you're writing $1 million check instead of a $50,000 check, they'll give you way better terms than deal. I'm talking like much better profit split, lower fees. They'll actually like call you back when you call, all kinds of stuff like that. So that is what we call a fund of funds structure. You can call it a syndication of syndication or whatever you want to call it. You're essentially creating a pool of capital to become one LP investor in the deal, or a side letter investor in the deal. And so that's what you do when you can't bring a significant amount of capital into the deal as, a co-GP or a manager. Once you can get over like 20 to 30% of the deal's overall equity raise, and sometimes it's a significant amount, then you can really start talking to the sponsor about like being listed as a co-manager.
Interesting. And so for someone who's listening right now that is unfamiliar with this kind of structure, why invest in a fund of funds model or a syndication of a syndication as opposed to just like going directly into the deal? Yeah. And I know that you covered this before, but I think it's important for people to remember.
There's a number of different reasons. The first and foremost, the most important reason and the real value proposition of doing a fund of funds is that you're collectively, with all that capital that you're raising, you're collectively negotiating much better terms in the deal for the investors. So on a typical deal, let's use an example. The sponsor is going to take 40% of the profits at the end, maybe 50% of the profits at the end. That's their profit split. It's also called a promote, carried interest, whatever. I will go to them and I'll say, instead of giving you a $50,000 check like your minimum, I'm going to write you $1 million check. But I want that profit split to be changed to 80-20, where you get only 20% instead of 50% of the profits at the end of the deal. And they'll either give me a side letter agreement for that or create an entirely separate share class for that for me. And I'll pass that benefit along to my investors. Now, of course, I have to get paid too. And so I take some fees out of that benefit for myself. But my investors end up in a situation where their upside's not being capped because they're not having to give up 50% of the profits. Yeah. They're getting way more upside in the deal because they're just having that straight 80-20 profit split.
And I think that's super important for everyone. There's power, in numbers, right? And so that's kind of what this whole philosophy of this whole fund of funds model really, takes advantage of, is the idea that a small little, retail investor, it's hard to get a seat at the table or to have an influence, But then the more assets you can pull together and present it as one large check, then you can usually have a lot more negotiating power. And that, I think that makes a lot of sense. So obviously, Elijah, we're going to have your information in the description box down below, so that if anyone's interested in learning more about Elijah's fund and how you could potentially work with him, you could be sure to check out the links down below. Let's talk about investments, Elijah. What investments have Goldhawk or has Goldhawk made in the last 6-8 months or so?
Sure. So we did a bunch of deals last year with Rise 48. These are like large multifamily buildings in Dallas. And then we did a large multifamily building in San Antonio with Lone Star Capital. We invested about $1 million into that one. And then we're actually working on another deal right now with a new sponsor relationship that we've been working on for over a year now. And I probably shouldn't give away all the details before we officially launch it. But it's a very experienced group out of California that does deals in Texas. So we're going back to Dallas. And but what's really interesting about the last couple deals that we have done is we have shifted somewhat away from getting heavy into like the B and C class heavy value add type of deals, because we can invest now in A and B plus class properties and get the same or higher returns than we would doing value add by doing a property tax exemption and assuming very good interest rates on long-term loans. And so that's a new strategy that we've been exploring, and we love it because we can buy an A-class property that's 100% occupied and rents are at market rates, and the property was just built last year, brand new property. We're going to get it at a discount because the market's distressed right now. And we're also going to go and put in 100% property tax exemption. And in Texas, where property taxes are really high, that is actually a huge benefit, to the point where it's like day one, our property value will increase by 30% just because of that property tax exemption. It's a brand new A-class property. It's awesome. And we're also on this deal going to be assuming a long-term like HUD loan at like 3.8%, which is awesome. So all the numbers work, plus there's no execution risk because property tax exemption is guaranteed on day one, and we don't have to renovate units or raise rents or do anything like that. We just have to buy and hold and realize our profits.
Okay, so we need to talk more about this property tax exemption thing, because I'm very curious. Like, you're making it sound super simple. I'm sure it's really like anything but simple. So how does one go about qualifying for and getting these property tax exemptions?
I'm going to keep it simple so that I don't confuse everybody. Different states and different cities have different types of rules, and most places don't have these types of exemptions available, but some places do, and they essentially allow you to apply. And if your building meets certain requirements, then this local government will waive your property taxes for a certain period of time. And so typically what it has to do with is affordable housing. So if you can keep your rents below a certain number, and usually that's like a percentage of the adjusted median income or whatever the local government decides to use as a metric, then you can qualify if a certain number of your units meet this threshold. And you just have to qualify for it. You submit an application. You can use a third-party consultant to help you do this, and they'll waive your property taxes for 5 years or 99 years. Depends on the program.
Interesting. So essentially, like, not the entire building, but a certain percentage of the doors need to be essentially affordable housing. Now, so when people hear affordable housing, they immediately think Section 8. I'm assuming that these aren't Section 8 tenants. This is just like a subclass, or maybe Section 8, but maybe not.
Section
I don't know.
8 is just like one like subsect of like affordable and like low income housing. There are so many different programs out there, and each local government like has their own different programs that you can apply for and meet. And sometimes there's even like public-private partnerships that will help you with this type of stuff too. So, I mean, just an example, you go to Texas and there's like 3 different programs. I'm not going to go into the details on this, but you can use Section 8 to do stuff, or you can, go and like qualify for property tax exemptions under any like one of these 3 programs, and each different location has their own programs and rules.
Yeah. Okay. Well, that's super interesting. And I'm assuming that these sorts of tax exemptions need to be applied for during construction or before the building's open. I'm assuming that this isn't like a value add play to an existing building, but rather.
So what I love about this is that the value add is done before closing. Like, we're not going to buy the property unless we're guaranteed to get this exemption. Same thing with like assuming the 3.8% loan. It's like, we're not even going to do the deal unless we're going to get that. And so it's almost like we're getting a property under contract, then applying for that exemption, or like coming up with a plan to meet the requirements and getting the pre-approvals and stuff from the local government, so that it's almost like we're stepping into a massive equity gain on the first day.
That's awesome. And so what I'm hearing is that you can buy existing properties and still qualify for these property tax exemptions.
Oh yeah.
Really? Okay.
Yeah.
So
there's such a shortage of affordable housing that these like local governments are willing to do a lot. They're willing to bend over backwards to essentially get people into housing. And so it's not just for construction, it's for all different types of properties.
So that's really interesting. And on average, Elijah, and obviously it varies by state, I'm sure, and area and like the property and everything, but like percentage wise, are we talking 10% of the building, 20% of the building, 30? What does that look like?
It's like 50%.
50%. Okay.
Yeah,
so like
it's
quite
higher.
a bit.
It's like you got to actually make a commitment. Here's the downside that people won't tell you. And I've heard mixed stories from different appraisers. Typically, when you're filling your building with a certain percentage of lower income tenants, that will somewhat impact the exit cap rate or the appraised cap rate of the building, but not to a significant degree. Like you're talking about like maybe like 10 or 20 basis points.
Okay.
So it does take a little bit of hit on the cap rate. So your property value is a little lower. However, when you're removing, a 3% property tax from your income statement, that the benefit far outweighs any loss in cap rate.
Right. Okay. And presumably these exemptions can be passed on to the buyer as long as they still meet the requirements and everything, and like you're still within the time frame or whatever.
Each program is different, but usually the way I think it's structured is that the new buyer either just assumes or they buy the LLC, so nothing's actually changing. They're just buying the company.
Yep, that makes sense. That makes a lot of sense. Cool, man. Well, that's actually a really interesting perspective, and I was actually, before we got into that, like my head went to, okay, so it sounds like Texas is kind of the place that you're focused on right now. Like that's kind of where you're honed in right now.
Texas and Phoenix, really the Sun Belt region in general.
What is it about Texas right now? Because, I'm sure that there's some investors who, and frankly, I'm kind of in this mindset too. So I'm asking you to change my mind here. Texas to me is an area where, like, if you think about where the money's going to be or versus where the money already is, it feels like that's a place where like predominantly like there's already a lot of money there. Austin, Dallas, these are markets where you feel like, okay, maybe we've missed the opportunity, right?
Yeah.
So
you say that as you live in California.
Yeah, exactly.
Like the money's already in California and it's
100%.
leaving California. Leaving California in droves. Like if you look at like net migration patterns, like so many people are leaving like the Pacific or leaving, the North, like New York and all these like highly restrictive states that have a lot of homeless problems and high taxes and stuff. And they're looking for a lower cost of living and a better quality of life and lower taxes. So they're moving to these locations, typically warmer climates and low taxes. So we're really talking about red states in the Sun Belt region here. Right. And net migration patterns are showing that like people are moving to these areas. And so, like I think places like Texas and Arizona and other, locations within the Sun Belt are getting a lot more populated. They're growing really, really fast.
So your argument is, real estate prices are high in these areas, but due to population growth, it's only going to get higher.
Yeah. So it's really a supply and demand thing. So, and I know there was a study that came out a few years ago that was like, we're 5 million housing units short or whatever. We then went through a period of super low interest rates.
Yeah.
You had something to say?
I'm like, if we're 5 million short, like where are all those people? Like on the streets? Like, I don't get it. But anyways, continue. Because whenever I do those stats, I feel like they made up.
They're all made up. It's all like, nobody actually knows, and like I haven't spent the time. So we went through a period of like 2020 and 2021 of like super low interest rates during COVID, and all these developers started building properties because the cost of capital was super low. And so you had like record numbers of starts, which is like new construction getting started. And those properties were all delivered in 2023 and now 2024, which is creating like a crazy supply and demand imbalance, but super like localized to these like high growth markets like Phoenix and some places in Texas and like places where I've essentially invested. And so you have this situation where there's like a temporary dysfunction or lull, like the supply and demand gap has kind of closed at this point. But what we're not considering is that the interest rate shot way up last year. And so all those builders that were looking to build more stuff couldn't start building new stuff last year. And so the deliveries that will occur in 2025 and 2026 are going to be way, way, way less than what we saw in 2023 and 2024. And that 5 million unit housing shortage, like that problem didn't go away. And when all of these new units stop getting delivered, and that problem is going to get a lot worse. The population is increasing. People are moving away from states like California, going to the Sun Belt. The problem is going to get way worse. You know, if you have a building that is struggling with occupancy in Phoenix, Arizona right now, just wait a year and it'll be 100% full, and you're going to have to raise rents another 20% so that you can meet the market. So that's where I think things are heading right now. But that's just my weird thought process.
I mean, it makes sense, right? Like you are seeing, or at least I've just noticed, like I'm not, studying these metrics on a daily basis because obviously like you're way more in the multifamily sector than I am. I'm focused more on hotels, but when when I'm just walking down the street here and I've been visiting a lot of different markets right now, just looking at hotel deals and whatnot. And so I there's a lot of cranes in the sky right now. Which is interesting in some of these bigger cities, and it's interesting to hear that perspective, right? Like there is a little bit of a delay. Nothing's getting started right now, right? These are all projects that were in the works before the rates rose,
right?
And so it's interesting because now I hear what you're saying. Like there's going to be a delay in kind of getting these buildings up to like the occupancy up, but like once we hit a certain threshold, we're gonna kind of fall back behind the 8 ball again. Yeah,
it's really like when do we hit like absorption? And it's like right now there are arguably more rentals available on the market in places like Phoenix than there are people looking to rent because of like thousands of units were delivered. Like what happens once like those units are actually absorbed? Everybody hits 100% occupancy, and then no more new supply hits the market for like 2 or 3 years. It's like, what are you going to do? Well, rents are probably going to shoot up 20% again.
Mm-hmm. That makes sense. That makes a lot of sense. What trends right now are you seeing in the multifamily space? So that's one of them, and I think that's a really interesting trend. What other trends have you observed, in the last 6 months, or what trends do you expect to see kind of coming up in the rest of this year or even in 2025?
Yeah. So buyers are still expecting large discounts due to distress, and sellers are only selling if they're distressed and have to sell. But transaction volume is ticking up. Like you look at transaction volume the last like 3 months, it's happening. It's starting to happen. Like they're starting to come together, usually at the buyer's price. The reason why is because a lot of these loans started maturing in 2023, these high interest bridge loans. And the first thing that happens is the sponsor or the operator will go to the lender and they'll say, look, I can't refinance because the interest rates are so high and the property's literally not kicking off enough income to support those payments. So no bank's going to lend me money. I need to work something out with you. And that bank really, really, really does not want to take the property back. They don't want to have to report a foreclosure, a failed loan to their investors or whoever. They don't want it to be published on the internet. So that bank will probably do anything they possibly can to avoid a foreclosure situation. That started happening like 9 months ago. And so all these sponsors were going to their lenders and saying, we're in trouble. We need an extension. We need a payment plan. We need to work something out. And the bank's not going to do that forever. You know, they'll put something into place and they'll be like, okay, within like 6 months or 12 months, like you better be back on track, or we're going to take the property.
Right.
I think right now, a lot of those deals got done. They're still getting done. But a lot of sponsors now are seeing, okay, we're still in trouble. Like, we're now into the loan modification. We've negotiated. We're running on thin ice here on borrowed time, and there's not much we can do here. The only thing we can do to avoid losing our investors' capital is to just sell the property and hopefully recover what we can. And so I think a lot of sponsors are coming to that realization right now, and they're actually parting ways with their property. And that's great for the buyers like us, because we feel like we're getting properties at a huge discount to what they're gonna be in 2 to 3 years from now. It's like the discount of a lifetime. Yeah. I don't think it will last forever. I think like we're talking like maybe throughout 2024, but probably not much beyond, because what happens right now is like the institutional guys and the family offices, they're not dumb. Like they know what's going on, and they're scooping up the best deals really fast, like with cash, like as fast as they can. And they're even going to the lenders and just buying the notes off the lenders in anticipation of foreclosing on the sponsors. So it's a problem that will get resolved very quickly, because the let me put it this way, the difference between like the intrinsic value of what the property should be worth or will be worth in a few years is drastically different than what you can buy it at today.
Yeah, I would agree. And it's interesting that a very similar situation is happening in the hotel world. Where, last year I was going to all these conferences, all these hotel conferences, and like every hotel conference, it was like, it's coming, right? Like the red wave, it's coming, like the red, or whatever they call it, right? Isn't red wave like political? Anyways, it's like the red, red wedding, right? It's
from Game of Thrones.
Game of Thrones, right? So that day is coming where people are going to start. It hasn't come yet, though. And so where are these wave of foreclosures? Where's this, where's the carnage that we were supposed to see? And what's happening is a lot of negotiations and backroom dealings, behind closed doors. And that is what people aren't seeing. And so like, you're wondering, well, why is so-and-so not losing their property? And it's exactly what you said. There's
also a lot of like cash infusions coming in the form of preferred equity. Essentially what that means is you're bringing in like a new investor into your deal at like a fixed interest rate to kind of save the deal and like provide that cash needed for the refinance. But that comes at a big cost. And those are like, those are the institutional guys. Those are the family offices. They're coming in with preferred equity. Sometimes we call it rescue capital, and they're saving the day, but really they're controlling the property at that point.
Right. And there's only so long that those sorts of things, like you're only putting a Band-Aid on the situation, right? It's not like you're truly fixing it. And really, it does hurt the LPs, because the LPs are the ones ultimately that are, their returns are the ones that are getting, squeezed by that pref equity or the rescue capital. And, it's interesting, man. It's really interesting. But now in the multifamily space, what I'm hearing is that you're finally starting to see some of the carnage, quote unquote, that we were supposed to see before.
Yeah. It's wild. I won't name any names, but like what started to come across my desk, there's a lot of like rescue deals, and included in those document packages are like the full like balance sheets and like SREOs of the sponsors, like all the managers involved. And these are people who like a lot of your listeners might have been like looking up to as like, wow, these are super rich, successful people. Like their balance sheet says they're worth $100 million, but here they are, they can't raise $1 million to bail themselves out of their deal. And all the properties on their balance sheet are right now at risk of foreclosure. And it's like, it's really crazy, really scary.
Yeah.
Like, I don't think the public really knows what's going on because people try to keep it hush and under wraps. But like, you just go and look at like the listings of all like the distressed loans out there, and it's all like publicly available information. Like, you'll see, it's like, it's impacting like a lot of sponsor groups right now.
Yeah, that's it's not surprising, and I think that we all knew this was coming. And by the way, in no way, shape, or form are Elijah and I like glorifying this or saying like, yeah, this is awesome. It's not awesome, right? Like, no one wants to see people.
Sucks.
Yeah, it does suck. And at the same time, like, these sorts of things happen, and when these opportunities arise, you're either sitting there playing armchair quarterback, or you're actually in the game trying to, get a piece of the action. Because the truth is like, these are the opportunities. These are the moments in time where generational wealth can happen, right? You can stumble into some situations, and we've been fortunate, our group has been fortunate to come across some deals very recently where it's like, wow, these are some home runs if we do it right. Yeah. So they're starting to pop up, but it's a slow ebb of, these types of deals. It's not like this like massive wave of foreclosures like I think we saw in 2008. And like, a lot of people were kind of expecting, like a similar kind of situation, but not yet. Not saying that it won't happen, but I would agree with you that I think that that there's a lot of jerry rigging and stuff in the back that's kind of keeping these things.
We're in that middle phase where it's like, try to figure it out, fix it, bring in more capital, negotiate with the bank, try to fix it. We're not yet at the thing where you're going to see like massive foreclosures happening every week.
How is the state of the economy right now, and the fact that this is an election year either helping or exacerbating the issue?
Really, I have no comment on that. But all I'll say is that the economy is strong right now. Like we are not in a recession. Interest rates are actually at a place where they're sustainable and healthy. Like, we're talking about like 5.5% to 6%, like on commercial loans. Like, we can just do that all day long. Like, that is sustainable. And the whole thing with the election, like, I really don't know. I'm not really into the politics. I think the geopolitical, like, global issues are actually going to have a lot more impact on real estate. Things like war in the Red Sea with the Houthis and all those like shipping containers that can't go through the Suez Canal, so they're going around Africa. That adds like a ton of cost to shipping goods worldwide. So it's like, I'm more worried about like that causing crazy amounts of inflation, and then the Fed having to raise rates again. It's like, that's what I think has more impact than even an election.
I can't say I disagree there. I can't say that I disagree. So that's it's a really, and actually we haven't had a lot of guests talk about that, and even in the hotel space, like, when you talk about FF&E and like the beds and the TVs and the lamps and everything, like, these are things that, especially when you're renovating a hotel, it's 200 keys or so. It's like those shipping costs go up dramatically, and it adds a lot to the to the renovation costs. So that's it's a very, I guess, timely observation on the potential impact for investors. So it's interesting. So obviously, Elijah, we're coming up on time here, but a couple last things for you, because you're a treasure trove of knowledge. And if you're listening to this podcast, you might not know this, but if you're watching this, you'd know, like, Elijah is still a young buck. I mean, this guy is super impressive. Has been doing this for
fools everybody.
Yeah. But it's just it's awesome to see how much you've been able to accomplish in such a short amount of time, relatively speaking, right? Because I have guests on this show that are almost double your age, and comparatively, it's not, I'm not playing the comparison game here, but it's just like, it's crazy how much you've been able to accomplish in so little time. And so for someone who's young, like a young guy who's in his early 20s, they're listening to this show, or young gal who's listening to this show right now, what's a piece of advice that you could give someone who's looking to get started in their investing journey, but they're using age as almost like a limiting belief.
Yeah. Your age doesn't matter. Just go and do a deal. You can read all the books you want, go on Bigger Pockets, read all the books, watch all the YouTube videos, pay for a $30,000 course. None of that shit's going to matter. Go and do a deal. And I mentioned this earlier, like real estate is more like running a business than doing actually like real estate. It's all about like leadership and problem solving. Just go do leadership and problem solving and apply it to real estate. Like, stop focusing on learning all the lingo and all the crap involved in real estate. Just go and do a deal and you'll learn everything you need to move forward. You might lose money on your first deal. That's okay. That's going to be your cost of your course. Don't go spend $30,000 to learn how to do real estate. Just go buy a rental property with your buddies and you figure it out that way.
Well, that's exactly what you did, right? You got your first investment property.
I spent about 2 weeks obsessing over the education before I decided to buy something.
Well, it's that classic. It's really funny because one of my first stories, or like one of my like first lessons in business, I was as you remember, I was a real estate agent before I got into hotels, and
a wildly successful agent.
I some would say, yeah, I had a good run. And the first night so I got my license in like the morning on like a Thursday, and it was in like the middle of December. So it was like the time where holiday parties and everything were happening. So I'd already chosen a brokerage to work at. And the founder of the brokerage that I worked at first, it was Intero Real Estate. They were actually acquired a few years before that by Berkshire Hathaway. And the CEO of Intero, the CEO of that brokerage, ended up getting cherry picked or like promoted to CEO of Home Services of America, which is like the real estate division of Berkshire Hathaway. So he was a big dog and had a kind of like an aura around him, right? This like real estate god, right? And Gino, great guy, has always been an awesome mentor for me. And when I got to the party, I knew who he was because he's kind of like a real estate legend in the Bay. And he, I introduced myself, so I told him like who I was, what my background was, and everything. And it's funny because like he had taken time to like fly back here for the Christmas party. He was away on business and everything. He's no longer with Intero, right? But like he still made it out for the holiday party. Shook my hand and he said, Dan, he didn't call me Dan. He said, Dan, I'm gonna give you one piece of advice. Don't let the minutia get in the way. That's all he said. Don't let the minutia get in the way. And I was like, huh? He said, don't let the minutia get in the way. All right, I'll remember that, right? And
such good advice, because like you'll have to do the minutia like when the job necessitates it. Like when you're in a situation where you're forced to like learn how an operating agreement works. It's like you'll figure it out.
Yeah, and I sat down. So the next day, I get to the office, and I decide that I'm gonna like market to this like community, right? So I'm gonna drop flyers and knock on door. They call it farming, right, in the real estate world. So I was going to farm this area. And so I get my laptop out. I'm like, all right, I'm in my suit and my tie. And I said, all right, I'm going to get working on it. So the whole day, 8 hours straight, I'm working on like Adobe Illustrator or whatever, like putting together this like flyer that I'm going to drop off, right? Second day, I get into the office, keep working on the flyer. And by the third day, I get to the office and I'm like working on the flyer, and I'm like, dude, I've been working on this for like 2.5 days. And I hear Gino's voice in like the back of my head. It's like, don't let the minutia get in the way. Don't let the minutia get in the way. And I think like, how am I ever going to like sell a house if I'm like trying to like be a designer,
graphic designer.
Right?
Yeah,
exactly. Like I'm not a graphic designer. I'm a salesperson. I got to get out there. So I get a little like for sale by owner list, and I start calling all the numbers and everything. And very first person that picks up I kind of go through like my dialogues and stuff that I've got here. I've never made a cold call in my life, by the way. And I nailed this guy for a listing appointment.
Damn.
I was like, and so I like shaking, dude. I like put my, I hang up the phone and my hands are sweating. And my lender, Monique, she was sitting two desks down. She like stands up. She's like, did you really just do that right now?
That's great.
And I was like, dude, I was like, don't let the minutia get in the way.
And
no, I didn't close him. That would have been epic. That would have been a story for the ages. But no, that guy was, that's the thing with for sale by owners. They take a lot of massaging, and they're usually just like way, especially here in the Bay Area, like these guys. Anyways, but the moral of the story is, and to kind of tie it all back together to what you just said, is like, hey, you can spend all the time studying, preparing, getting ready, getting set, putting the war paint on and everything, or you just go out and freaking do it, right? Which is exactly what you just said, right? Like you spent a couple of weeks getting educated and stuff, and then you're like, what? You probably had a moment, right, Elijah, where you were like, what am I doing right now?
Yeah.
Right?
Yeah.
Like,
Wow,
and then
absolutely.
you just did it. Yeah. You just did it. So you didn't let the minutia get in the way. Hey, Elijah, it's been awesome, man. So glad that you came back on the show. And I'm sure this won't be the last time, but in traditional Gould Mine fashion, before I let you go, what is one final Gould nugget for the audience?
Awesome. I prepared so hard for this one because I knew it was coming. I actually developed like a spreadsheet for your listeners for calculating some of those metrics that I talked about earlier on the podcast. And so they can go and download that or open the Google Sheets file. It's super simple to use. And it's essentially like the top 4 metrics that I use when I'm looking at a deal to know if it's like safe or not. And it's at goldhawk.us/LP calculator. LP calculator. And they can go to that site and enter their information, and then I'll email you the thing. So yeah,
I love it. I love it, man. No, that's great. And honestly, the metrics that you talked about, being able to calculate those and having a simple calculator like that, that's super valuable. So I appreciate that, Elijah. You're awesome, dude.
Of course, it's that's the least I can do.
All right, man. Well, hey, I appreciate you, and as always, you're a treasure trove of knowledge, man. So thanks for stopping by.
Thanks so much, Danny. Appreciate it.